Welcome in this video. When will ZBCN coin start to rise? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. Looking carefully at the chart, we can clearly see that the price has been struggling against a certain falling trend line for a long time. This trend line has been acting like a strong wall of resistance, constantly blocking the price's upside attacks. Although the price has occasionally come close to this level, it has so far failed to break this resistance line upwards in an effective and voluminous manner. This is an important technical structure that investors watch carefully. Falling trend lines in particular not only provide information about the general direction of the market, but also signal a trend reversal when they break. Therefore, an upside breakout of this line would be considered a critical technical development. This downtrend has been tested many times in the past. Although the price has attempted to break through this level on each contact, it has not been successful due to lack of sufficient buying power or market uncertainties. However, each new test can mean weakening resistance in technical analysis. In other words, the more often a level is tested, the less strong sellers are there, and eventually the barrier may be breached. One of the most important things to consider at this point is the conditions under which the breakout will occur. A breakout, especially on high volume, indicates that this level has been crossed permanently, and the price action that follows will be stronger. Price reactions to this falling trend line also reflect the psychological state of the market. Each contact raises the "will it break now" expectation of some traders in the market, while each unbroken attempt leads to continued short-term declines. However, these constant attempts also reveal price interest and pressure. In technical analysis, this type of formation is called an impending breakout. This means that the price is now stuck, and it's only a matter of time before it sets its direction. As soon as the breakout occurs, the energy accumulated on the price is suddenly released, creating a serious bullish potential. Although falling trend lines may once indicate that the market was pressured to the downside, breaking through such resistance often results in a trend reversal. This means that as soon as the price breaks this line to the upside, not only a short-term uptrend is possible, but also the start of a larger bull trend. Such technical structures help traders with both entry and target setting. For example, with a break of this trend line, the first target is usually the previous highs. If these targets are also crossed, the price can reach much higher levels. Moreover, breaking the downtrend is not only important from a technical point of view, but also from a psychological one, because a persistent failure to break this resistance level weakens buyers in the market over time. However, when this line is broken, many investors perceive this break as a confidence signal and re-enter the market. This leads to an acceleration in price momentum. Algorithms and big traders in particular treat such trend breaks as buy signals. This causes price movements to accelerate not only for technical reasons, but also due to a change in market psychology. After the breakout, the price usually retests this trend line once again. This test is called a retest in technical analysis. If this retest is successful and the price bounces back up from this line, this confirms that the breakout is solid and the uptrend can continue. If there is an increase in volume or strong green candles during the retest, traders' confidence grows even more and new purchases are triggered. But we can't decide the analysis only by trends. Let's look at other metrics. Stay tuned. The Elliott wave theory is a powerful analytical tool that argues prices in financial markets move within certain structures. According to this theory, prices develop cyclical formations based on psychological tendencies, and these formations must adhere to specific rules. One of these rules is that, in order for a wave count to remain valid, the price must not violate certain critical levels. One such critical point is the starting level of the first wave where the Elliott count begins. If the price falls below this fundamental level, the Elliott wave count up to that point becomes technically invalid and must be reassessed. This situation becomes especially critical during the formation of the second wave. According to Elliott's rules, the second wave must never go below the starting level of the first wave. If it does, it contradicts a fundamental rule of the theory, rendering the current count invalid. Therefore, it is crucial to monitor whether the price stays above this level during analysis. When the price approaches this critical point, market participants often wonder, will this level be broken, or will the market bounce back upward? The answer to this question is important not only technically but also psychologically, as holding this level maintains the bullish sentiment in the market. If the level is broken, however, investors typically reassess their positions and often change direction. During the second wave, the price often undergoes deep corrections. These corrections can extend to Fibonacci levels of 61.8%, 78.6%, or even 88.6%. However, no matter how deep the pullback is, as long as the price does not drop below the starting level of the first wave, the Elliott wave count remains technically valid. This indicates that the market is still in a larger impulsive wave, and the decline is merely a temporary correction. In such a case, investors usually remain patient, as the third wave is believed to be the strongest and most powerful move. According to the Elliott wave theory, the third wave is often the longest and most aggressive upward or downward movement. Thus, the low point of the second wave sets the stage for the third wave. If the price violates this fundamental rule and falls below the starting point of the first wave, it not only invalidates the count, but also signals a shift from the expected market direction. In this scenario, either the wave count was incorrect, or the market has entered a different structure. In both cases, the investor must restructure their technical analysis and revise it according to the current situation. This helps prevent potential misinformed decisions. Another important detail is that at these critical levels, seen as red lines, not only is technical analysis tested, but also the investor's strategy. For traders who operate based on wave counts, these levels often represent stop-loss points. If the price dips below this level, systems automatically close positions because the technical setup is no longer valid. On the other hand, if the price bounces back from this level, confidence is often restored and buying pressure increases. To keep an Elliott wave count valid, it's essential to adhere strictly to these rules not only in theory but also in practice. Success in technical analysis often comes from disciplined adherence to rules. This means that if the price truly does not break this level downward, it makes sense for investors to continue with their existing analysis. However, if a break does occur, they must be just as determined in abandoning their current strategy and starting a new analysis process. The Relative Strength Index, or RSI, is one of the most commonly used momentum-based technical indicators that helps us identify whether the market is in overbought or oversold territory. The RSI value oscillates between 0 and 100, and certain ranges of these values have the potential to show us important turning points. In the chart, we can see that the RSI has now reached a critical zone, where it has repeatedly reacted strongly in the past and has become the starting point of an upward movement. This zone may not only be limited to the numerical 30, 40 levels, but also areas defined by a rising or horizontal trend line on the RSI, which sometimes acts as a dynamic support line, can also be an area of strong reversal. In the current situation, we can see that when the RSI has repeatedly touched this level in the past, the price has reacted to the upside and initiated strong rallies. In this context, we can say that the current RSI level is not just a number, but also a zone that reflects investor psychology. RSI needs to bounce from here. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.